Nobody told you this would feel so confusing. You've worked your whole life, paid your bills, raised your family, saved when you could. And now you're sitting here, looking at a retirement account that feels thin. And somewhere between the headlines about the market crashing and the ads promising 10 times returns overnight, you've been paralyzed. Not because you're careless, but because no one ever sat down with you, without a sales pitch, without the jargon, and just explained how this thing actually works. That's what today is about. Not tips, not hacks, not a formula designed to make someone else rich. Just the truth about the stock market and how someone at your exact stage of life can actually use it to build something real, something that lasts. Because here's what I need you to hear before we go any further. It's not too late, but the way you've been thinking about this might be. And that's the first thing we need to fix. There's a number that changes everything. Not your salary, not your savings account balance, not the value of your house or your 401k statement. A different number. One that most people never calculate. One that, once you see it, you can't unsee it. It's called your FI number, your financial independence number. And it's the only number that actually matters when we're talking about retiring early. Here's how it works. Take what you spend in a year. Everything. Mortgage or rent, groceries, utilities, insurance, the dinners out, the vacations, the things you tell yourself are small. Add it all up. Get honest. That's your annual expenses. Now multiply that number by 25. That's it. That's your FI number. If you spend $60,000 a year, your FI number is $1.5 million. If you spend $40,000, it's $1 million. If you spend $80,000, it's $2 million. Simple math, but most people have never done it because nobody sat them down and said, here is the finish line. Now, where does that 25 come from? It comes from something called the 4% rule. Research from the 1990s, the Trinity study, looked at historical stock market returns and figured out that if you withdraw 4% of your portfolio per year, your money has a very high probability of lasting 30 years, maybe longer. 4% withdrawal. Flip that upside down. Multiply by 25. Same thing. And I know what some of you are thinking right now. $1.5 million? That sounds impossible. I understand that feeling, I do. But stay with me, because the math is about to get a lot more interesting and a lot more human than you've been told. Because here's what nobody explains. The path to your FI number isn't just about how much you earn. It's about the gap between what you earn and what you spend. That gap, that space, is the engine of everything. A person making $80,000 a year and spending $50,000 is building wealth faster than someone making $150,000 and spending $145,000. Income is not the variable. The gap is the variable. And this is where most people over 40 have actually been handed an advantage they don't recognize yet. You're not 25. You're not starting from zero in every sense of the word. You have something younger people don't have. You've already eliminated some of the noise, the lifestyle inflation, the trying to impress people, the spending money on things that never quite fit who you became. A lot of you are, right now, closer to your FI number than you think. Not because you're rich, but because you've quietly been learning, for decades, what actually matters to you. And that knowledge has a dollar value, a real one. The math we're doing today isn't just arithmetic. It's translation. We're translating the life you've been living into the life you're actually trying to build. And the first step is knowing your number. So before the next block, I want you to do one thing. Just one. Estimate your annual expenses. Don't overthink it. Round numbers are fine. And multiply by 25. Write it down somewhere. That number you just wrote? That's your finish line. For the first time, maybe ever, you know where you're running to. Here's something nobody warns you about. The stock market doesn't scare most people because of the numbers. It scares them because of the stories. The coworker who lost everything in 2008. The uncle who put his retirement savings into one company and watched it disappear. The headline you scrolled past last Tuesday that said the market dropped 400 points in a single day. Those stories are real, and they did real damage to real people. But here's what those stories almost never include: the part that gets edited out before it reaches you. What happened next? After 2008, the market didn't just recover. Within 5 years, it had not only recovered, but surpassed where it was before the crash. People who held their positions, who didn't panic, who didn't sell, came out ahead. Significantly ahead. The people who lost everything, almost all of them had one thing in common. They were too concentrated, too much in one place, too exposed to one company, one sector, one bet. And that brings us to the single most important concept in investing for someone at your stage of life: diversification. I know, the word sounds like something a banker says right before they hand you a brochure. But strip away the jargon, and it's actually one of the most human ideas in finance. Don't put everything in one basket. Your grandmother probably said it better than any textbook ever could. In practice, diversification means spreading your money across many different companies, industries, and sometimes countries, so that when one part of the economy struggles, another part can hold the weight. And the most elegant way to do that, especially if you're not interested in spending hours researching individual stocks, is something called an index fund. An index fund doesn't try to beat the market. It simply mirrors it. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of the 500 largest companies in America all at once. Apple, Microsoft, Johnson & Johnson, Berkshire Hathaway, all of them in one move. No picking, no guessing. No watching CNBC at 6 a.m. trying to decode what the Federal Reserve is going to do next. Just steady, consistent participation in the growth of the American economy. Warren Buffett, arguably the greatest investor who ever lived, has said publicly that for most ordinary investors, a low-cost index fund is the smartest investment they can make. Not because it's glamorous, because it works. But here's the layer underneath that most people miss. It's not just about what you invest in, it's about where you hold it. If you're working and your employer offers a 401k, especially one with a company match, that is the closest thing to free money you will ever encounter in your financial life. A company match means your employer adds money to your retirement account based on what you contribute. If they match 50 cents for every dollar up to 6% of your salary, and you're not contributing at least 6%, you are leaving your own compensation on the table every single year. And if you're self-employed, or if you've maxed out your 401k, there's another account worth knowing: the IRA, Individual Retirement Account. Traditional or Roth, depending on your tax situation. Both offer significant advantages that a regular brokerage account simply doesn't. I'm not going to go deep into the tax mechanics right now. That conversation deserves its own time, and frankly, your specific situation deserves a real professional who can look at your numbers. What I want you to take from this block is simpler than all of that. The structure matters as much as the strategy. You can pick the right investments and still leave enormous value behind if you're holding them in the wrong type of account. And you can have a perfectly ordinary portfolio, boring, even, and build genuine wealth over time if the foundation is right. Most people spend all their energy trying to find the perfect stock, the hot tip, the next big thing, the ones who actually retire comfortably. They usually can't tell you a single exciting story about their investments, because boring, consistent, and correctly structured is the strategy that wins, not the one that makes for a good story at dinner. Let me tell you about the worst financial decision most people make. It doesn't happen in a broker's office. It doesn't happen because of a bad tip or a poorly chosen fund. It happens on an ordinary Tuesday morning when the person opens their phone, sees that the market dropped 600 points overnight, feels something cold move through their chest, and sells. That moment, that one decision. It has destroyed more retirement plans than any market crash in history. And I say that not to frighten you, but because understanding why it happens is the only way to make sure it never happens to you. Here's the truth about market volatility that nobody in finance seems to want to say plainly. The drops are part of the design, not a flaw, not an anomaly, not a sign that something has gone terribly wrong. The drops are the price you pay for the gains. Historically, the stock market experiences a decline of 10% or more roughly once every 2 years. A drop of 20% or more, what's technically called a bear market, happens about once every 4 years. And drops of 30%, 40%, even 50%. They've happened. 2001, 2008, 2020. Every single time, the market recovered. Every single time. But here's what the recovery chart never shows you. It doesn't show you the people who sold at the bottom. The ones who watched their account drop 30% and couldn't take it anymore. Who told themselves they'd get back in when things stabilized. They never got back in. Or they got back in too late, after missing the sharpest part of the recovery. Because that's another thing nobody warns you about. The market's biggest single-day gains almost always happen in the middle of its worst periods. Miss those days, and you don't just miss the recovery, you miss most of it. There's a word for the ability to watch your account drop and not flinch. Risk tolerance. And at 40, 50, or 60, your relationship with risk is one of the most important things to get honest about. When you're 30, time is your greatest asset. You can afford to take on more risk because you have decades to recover from a bad year. When you're closer to retirement, the math changes. You're not just building anymore. You're also starting to think about preservation, about not losing what you've already made. This is where asset allocation comes in. The balance between growth assets, like stocks, and more stable assets, like bonds. A classic rule of thumb used to be, subtract your age from 110. That number is the percentage of your portfolio that should be in stocks. At 50, that's 60% stocks, 40% bonds. At 60, it shifts more conservative. It's not a perfect formula. No formula is. But it gives you a starting point. A framework for thinking about the ratio between growth and safety that makes sense for where you actually are in life, not where a 28-year-old investing influencer is. And this matters more than most people realize, because the single biggest risk for someone in their late retirement years isn't a market crash. It's what financial planners call sequence of returns risk, which simply means it matters enormously when the bad years happen relative to when you start withdrawing. A brutal bear market at 45 is painful but survivable. You have time. A brutal bear market at 67, right as you're starting to live off your savings. That's a different conversation entirely, which is why the strategy shifts as you get closer. Not panic, not abandonment. A thoughtful, intentional shift in how much risk you're carrying, moving gradually, consistently, toward a portfolio that can weather a storm without forcing you to sell at the worst possible moment, just to cover your monthly expenses. This is why I keep coming back to the same word. Foundation. Not tips, not tricks. Not the stock your nephew swears is about to take off. A foundation. Built intentionally, adjusted over time, aligned with where you actually are and where you actually want to go. Because here's what I've learned about the people who retire well. They're not the ones who found the secret. They're the ones who stopped looking for it and started building instead. There's a wall nobody talks about. You've done the math. You know your FI number. You're saving aggressively. Your investments are growing. And then someone asks you, but how do you actually use that money if you retire at 52? And the room gets quiet, because most of the money people save for retirement is locked inside accounts designed for people who retire at 65. Touch it before 59 and a half, and the IRS charges you a 10% penalty on top of regular income taxes. So what's the point of retiring early if you can't reach your money? This is the question that stops a lot of people, and it's a legitimate one. But there are answers. Real, legal, tested answers. And they've been sitting in the tax code the entire time. Let me walk you through the main ones. The first is something called a Roth conversion ladder. Here's how it works. When you retire early, before 59 and a half, you start converting money from your traditional 401k or IRA into a Roth IRA. You pay income taxes on what you convert, but no penalty. Then, 5 years after each conversion, that money becomes completely accessible, tax-free, penalty-free. The key is to start the ladder early enough. If you plan to retire at 52, you begin converting at 47 or 48. By the time you retire, the first rungs of the ladder are already accessible. Each year, another rung opens up. It requires planning. It requires patience, but it works. And for people who have significant money in tax-deferred accounts, it's often the most powerful tool available. The second option is Rule 72T, also known as SEPP, Substantially Equal Periodic Payments. This rule allows you to begin taking distributions from your IRA before 59 and a half, penalty-free, as long as you take them in equal amounts over a fixed schedule, at least 5 years, or until you reach 59 and a half, whichever comes later. It's less flexible than the Roth ladder. Once you start, you're committed to the schedule. But for someone who needs income immediately and doesn't have 5 years to wait, it's a real option. The third, and often underestimated, tool is simply a taxable brokerage account. This is money outside of any retirement account. No age restrictions, no penalties. You invest it, it grows, and you can access it whenever you want. You pay capital gains taxes on the growth, but at long-term rates, which are significantly lower than ordinary income rates if you've held the assets for more than a year. For early retirees, the strategy often looks like this. Live off the taxable account first, in the years between retirement and 59 and a half. Let the tax-advantaged accounts keep compounding untouched. Then, when the door legally opens, shift to drawing from those. Meanwhile, the Roth ladder is running in the background, building, opening up, year by year. None of this is complicated once you see the structure, but it requires you to think in sequences, not just balances. It requires you to look at your money not as one pile, but as several, each with its own rules, its own timeline, its own purpose. That's the real financial literacy that changes outcomes. Not stock picking, not market timing, not finding the next great fund. It's understanding the rules of the game well enough to route your money through the system efficiently. The people who retire early aren't smarter than you. They're not luckier, most of the time. They just learned this architecture before most people knew it existed. They planned around the wall instead of walking into it. And now you know it exists too. Which means the wall just got a door. At some point in this conversation, you might have started doing math in your head, taking what you have, adding what you think you can save, projecting it forward, asking yourself, quietly, maybe a little anxiously, is it going to be enough? That question deserves a real answer, not a reassuring, vague answer, a real one. And the honest truth is this: enough is not a fixed number. It's a ratio. Financial planners have used something called the 4% rule for decades as a starting point for retirement withdrawals. The idea is straightforward. If you have a retirement portfolio, you can withdraw roughly 4% of it per year, adjusted for inflation. And statistically, your money should last 30 years or more. So if you have $1 million saved, 4% is $40,000 a year. If you have $500,000, that's $20,000 a year. If you have $750,000, you're looking at $30,000 annually from your portfolio alone, before Social Security, before any pension, before any other income source. Now, the 4% rule is not a guarantee. It's a guideline built on historical data. Some financial planners today suggest being slightly more conservative, closer to 3.5%, given current market conditions and longer life expectancies. Because here's something we don't talk about enough. People are living longer, much longer. A 65-year-old American today has a reasonable chance of living into their late 80s or even their 90s, which means your retirement savings might need to last 25, 30, even 35 years. That changes everything. It means the old model, work until 65, collect a pension, live modestly for a decade, doesn't fit anymore. The runway is longer. The money has to stretch further, and the strategy has to account for that reality honestly, not wishfully. This is why the investment conversation for people over 40 isn't just about growth anymore. It's about growth and longevity, about building a portfolio that doesn't just get you to retirement, but carries you through it. And that requires thinking about something most people avoid entirely until it's almost too late. Healthcare. According to Fidelity's most recent estimates, the average retired couple in America will spend roughly $315,000 on healthcare costs over the course of their retirement. That number doesn't include long-term care, nursing homes, assisted living, in-home aids, which can add hundreds of thousands more. I'm not saying that to frighten you. I'm saying it because the people who retire with real peace of mind are the ones who looked at those numbers clearly, early enough to do something about it. Health savings accounts, HSAs, are one of the most tax-efficient tools available for this purpose. Triple tax advantage. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Most people treat their HSA like a checking account for copays. The smarter move is to treat it like a second retirement account. Contribute the maximum, invest it, and let it compound for years before you touch it. 1 tool. 3 tax advantages. Almost nobody uses it to its full potential. But here's the thread running through everything we've talked about in this block, and every block before it. The gap between knowing something and doing something about it. That gap is where most retirement dreams quietly die. Not in a crash, not in a catastrophic decision. In the slow accumulation of years where you meant to get around to it, where you told yourself you'd sort out the 401k contributions next quarter, where you kept your emergency fund in a savings account earning 0.01% because you never got around to moving it somewhere better. Intention without structure is just wishful thinking wearing a plan's clothing. The people who actually arrive at retirement with options, not desperation, not dependency, but genuine options. They built systems, automated contributions, scheduled reviews, written down goals connected to real numbers, not because they were more disciplined than you, because they made the decision once and let the system do the work. You don't have to be perfect. You just have to set it up right. And then show up, not every day, not obsessively, but consistently. The same way you showed up to everything else in your life that mattered. Because this matters. Maybe more than anything else we don't talk about at the dinner table. Before I go any further, I want to stop for just a moment. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Because what we do here isn't about hype. It isn't about predicting the next big thing or telling you what you want to hear. It's about giving you the kind of honest, grounded, financial perspective that most people in your position never got. And honestly, should have gotten a long time ago. If that's the kind of content you've been looking for, this is where you belong. Now, let's talk about the one thing that ties everything together. The piece that, without it, everything else we've discussed today is just interesting information that never becomes real money. The actual decision to begin. I've spoken with a lot of people over the years about money, not in a formal way, just conversations, at dinner tables, in waiting rooms, in that quiet space where people let their guard down and say what they're actually thinking. And almost universally, the people who hadn't started investing yet didn't lack information. They didn't lack access. They didn't even lack the money in most cases. They lacked permission. Permission to start before they fully understood everything. Permission to invest imperfectly rather than not at all. Permission to begin with whatever they had. $100, $200, $500 a month. Instead of waiting until they could do it the right way. Here's what I want you to hear. There is no right way that exists somewhere in the future, waiting for you to be ready. There's only the way you start today, that you improve over time. A $300 monthly contribution to a Roth IRA, started at 47, invested consistently in a low-cost index fund for 20 years, at a conservative 7% average return, grows to over $175,000 from $300 a month. From starting imperfectly on a Tuesday because you finally decided to stop waiting. That's not a fantasy. That's math. And the math doesn't care whether you felt ready. It only cares whether you started. Now, I want to address something directly, because if you've been listening this carefully for this long, there's a good chance one of these thoughts has crossed your mind. I don't know enough to do this on my own. Good. You shouldn't do it entirely on your own. A qualified financial advisor, specifically a fiduciary, which means someone legally required to act in your best interest rather than their own, can be one of the most valuable investments you ever make. Not because you're incapable, but because having someone who knows your full picture, your income, your expenses, your goals, your timeline, and can build a strategy specifically for you is worth far more than the fee. The key word is fiduciary. Ask before you hire anyone. If they hesitate to confirm it, walk away. You can also start simpler than that. Most major brokerage platforms, Fidelity, Vanguard, Schwab, have free tools, educational resources, and even basic automated investment services that can help you start moving before you're ready to sit down with a professional. The goal right now isn't perfection. The goal is momentum. Because here's something I've seen again and again. The moment someone makes their first real investment, not a test, not a hypothetical, an actual contribution to an actual account, something shifts. The market becomes less abstract. The numbers become less intimidating. The whole thing starts to feel like something you're part of, instead of something happening to other people. That shift is available to you. Today, not next quarter, not when the market settles, not when you feel more ready. Today. Because every month you wait isn't just a month of missed growth. It's a month of compound interest that will never come back. And unlike almost everything else in life, the time you lose in investing cannot be recovered by working harder later. This is the one place where starting matters more than starting right. We've covered a lot of ground today. The mechanics of the market, the psychology of fear, the quiet power of consistent investing, the accounts that protect what you build, the numbers that most people never sit down and face honestly. But I want to close with something that has nothing to do with any of that. I want to talk about what this is really about. Because it was never just about money. Not really. When someone in their 40s or 50s starts getting serious about retirement, it's rarely because they suddenly became interested in index funds. It's because something shifted. Maybe the kids left the house, and for the first time in years, there was silence. And in that silence, a question surfaced that couldn't be pushed back down. What is the second half of my life actually going to look like? That question is the real thing underneath all of this. Not the 401k, not the Roth conversion, not the sequence of returns risk. The question of whether the life you've been building, quietly, steadily, through decades of effort and sacrifice and compromise, is going to land somewhere worth arriving. That's what a retirement strategy is actually for. Not a number in an account. A life you can live on your own terms, without the alarm clock, without the commute, without the slow erosion of doing work that no longer means anything to you, just to keep the lights on. That's the thing worth building toward. And here's what I believe, not as a financial concept, but as a plain human truth. It is not too late to build it. Not if you start moving. Not if you stop waiting for the perfect moment that was never coming. Not if you take even one concrete step this week. Opening an account, increasing a contribution, scheduling a conversation with a fiduciary advisor, just looking honestly at the numbers for the first time. One step. Not the whole staircase. Just one step. Because the people who arrive at retirement with dignity and options and genuine freedom didn't do anything extraordinary. They just didn't stop. They kept going through the years when the market scared them, through the years when life got expensive and the contributions got smaller, through the years when it felt pointless or too slow or too late. They kept going. And the math, patient and indifferent and precise, rewarded them for it. I don't know exactly where you are right now, what your account looks like, what your timeline is, what kept you from starting sooner, or what finally brought you to a video like this one today. But I know this. You're still here. You watched this far. And somewhere in you, there's something that wants to get this right. That's enough to start with. So if this conversation meant something to you, if something landed, if something shifted, even slightly, I'd ask you to do 3 things. Follow this channel. We do this every week, honest, grounded conversations about the financial decisions that actually matter for people at your stage of life. No hype, no schemes, just clarity. Share this video with 5 people you care about. 5 people who are also trying to figure out the second half. Because this kind of conversation is better when you're not having it alone. And leave a comment below. Tell me honestly, what's the one thing from today that hit closest to home? What do you want us to cover next? Your suggestion might become the next video someone else needed to hear. The market will open tomorrow morning whether you're ready or not. The only question is whether you'll be in it.